going into the fourth quarter of last year, you'd had a significant drawdown, and some of the tech and consumer names that we owned had reached valuations that they could have kept going down had we saw a continued economic deterioration, but they were at price points that we felt comfortable continuing to hang on to some of those positions. And those happen to be the ones that have really rallied well to start this year. And now, if we get a new client that wants to have stocks in their portfolio, there's very few of those names that we're buying for them today, just because we think that the prices have outrun what our estimates of the fair values of those companies are. So we'll wait to see if there's a pullback and then opportunistically buy in once we see those prices that we'd like to buy at.
On this episode of What the Finance podcast, I have the pleasure of speaking with Chance Finucane, who's Chief Investment Officer of Oxbow Advisors. So, Chance, thanks so much for coming on the podcast today.
Yeah, thanks for having me on your show, Anthony.
No problem. I'm really looking forward to our conversation because I guess if we look at sort of what's happening during this year, a lot of people were quite bearish coming into the year, and I guess a lot of them have been proven wrong. It's been, a very strong start to the year. I guess you could say economically as well, it hasn't been as bad. We have seen banking crisis sort of in March, but other than that, it seems to be strong. It looks like the Fed may be landing its plane. We'll see what happens. But what are your thoughts, and what are you currently seeing, I guess, in the economy and the markets as well?
Yeah, we'd agree. The strength in the equity market has been more than we expected. We were bearish for all of last year, which was a good call, but we were still pretty cautious and conservative in how we were managing our clients' portfolios going into this year. The majority of what we owned in stocks in our equity portfolios for clients was in the tech and consumer cyclical sectors that have done very well. But we could have been even more risk on that might have benefited in the first 6 months of this year. But we really try to take a multi-year view in how we position the portfolios and are always focused on the downside risk. And so given where we are now, which is really all that matters at this point, where you have the S&P 500 trading at nearly 20 times forward earnings, that doesn't mean that the market has to turn around and go down tomorrow, but it just means that your expected returns over the next several years, if this is your starting point, are not going to be very high. And when you compare that to a short-term treasury yield of nearly 5.5%, it doesn't really pay to take any excess risk beyond stocks or something in any asset class that you find that really is trading at an undervaluation compared to its own history. So we can walk through in more detail about what that means for different asset classes, but right now we're just being very mindful of what we're willing to pay with that 5.5% treasury that we can put our clients' assets in if we don't find anything better.
Yeah, it's a great point. And it's interesting to hear that you had a little bit of risk, I guess, on sort of at the end of last year. Why was that? Because I guess it was quite negative sentiment. A lot of people were thinking that, even though a lot of those companies had gone down a lot, there was further downside to come.
We always try to keep a balance in our clients' portfolios. We never want to have all of our choices be riding on one specific outcome, just because trying to invest in the financial markets will always humble you, because there will be things that happen that nobody can foresee on a consistent basis. And so we try to consistently make reasonable choices, not do anything stupid, rather than focusing on trying to make the next brilliant investment. We think it's a more sustainable and better strategy. Just try to make plays that you think are easier to make, that make a lot of sense. So going into the fourth quarter of last year, you'd had a significant drawdown, and some of the tech and consumer names that we owned had reached valuations that they could have kept going down had we saw a continued economic deterioration, but they were at price points that we felt comfortable continuing to hang on to some of those positions. And those happen to be the ones that have really rallied well to start this year. And now, if we get a new client that wants to have stocks in their portfolio, there's very few of those names that we're buying for them today, just because we think that the prices have outrun what our estimates of the fair values of those companies are. So we'll wait to see if there's a pullback and then opportunistically buy in once we see those prices that we'd like to buy at.
Yeah, it's interesting. Have you been rotating into, I guess, other sectors maybe that haven't seen that upside, or have you, as you said, it's easy just to put it into cash or into bonds at the moment, or bills when they're yielding 5.5%?
Sure. Well, we don't hesitate to put money into that 5.5% treasury if we don't see anything great, but we are finding opportunities in other sectors of the market. So over the last several months, we've started to see a pullback both relatively to the market and on an absolute basis in some of the defensive sectors. So we've increased our weight in the healthcare sector. We bought a utility, which we had not bought a utility stock in a long time, but they were starting to get to levels that we thought were somewhat undervalued and were very undervalued compared to the market. And then within our high income strategy, we were starting to see some opportunities several months ago in the energy sector with the pipelines that were delivering dividend yields of anywhere between 7 and 10%. And those were really good price points for us to be able to buy in for clients that didn't already own that within their high income portfolios. And we've started to see a reversion now where you're seeing the price of oil and other commodities drift back up, and are glad that we're able to get some of those positions in place.
Yeah, it's interesting. And when you say they're undervalued, I guess compared to competitors or just compared to the markets, what does that mean in your opinion? And I guess how would you then measure if something's undervalued, and if, you know, from your perspective, you think it should be potentially added to the portfolio, or at least watch to see what happens?
It varies depending on the type of company that you're looking at. So depending on the sector or the industry, but we like to look at valuation from multiple vantage points. So you're going to have a framework for an absolute valuation, and we never want to overpay for an asset. We always want to be able to buy at a discount. So for certain types of businesses, a simple price to earnings ratio or a free cash flow yield, or in some other sectors, it might be enterprise value to EBITDA, or it could be like in the financial space, price to tangible book value is an important thing to look at for a bank. So you really want to know what it is the best way to value something on an absolute basis. But then on top of that, we also want to compare to where certain sectors are valued compared to the overall market. And that's especially valuable with defensive sectors. So certain industries within healthcare, if you look at consumer staples, and if you look at utilities, those are categories that tend to have their biggest stretches of outperformance begin from a low relative multiple. And if you're able to move in at a low relative multiple, so for example, let's say Unilever normally trades at about a 20 to 25% premium for its price to earnings ratio compared to the overall market. But right now, it often is trading at a discount to the overall market, which is a surprise considering that you normally would rarely see that. And so if you can find an absolute price level that you think is worth paying and it still has that discount versus the S&P 500, that's a good time to buy a consumer staple like that.
I think is this a bit of an ominous, I guess not warning, but ominous trend that a lot of these companies are maybe at the lows, and you're seeing that they're potentially could start mean reverting back to where they traditionally were. Normally, that I guess you'd say that happens when you know, stuff goes wrong in the economy.
Yeah, I think you're right. It doesn't have to mean a doom and gloom outcome, but it does mean that for those sectors, a reversion to the mean strategy tends to work. So if you compare this to say like a retailer, if a retail business is starting to weaken and is losing market share to its competitors, it's very likely not going to turn around, and betting on that sort of a turnaround and back to the average is usually not a good strategy in a very competitive cyclical environment like that. But for a very stable and steady business like a consumer staple or a healthcare, that reversion to the mean relative to the market tends to pay off over a 1 to 3 year time horizon. So if you're seeing these cheap relative price to earnings multiples for the defensive sectors, you're right. That's probably a good time to be moving towards the defensive area, maybe moving some to that short-term treasury and taking a little bit of risk off the table. And the last time this happened was after we had that big initial surge in stock prices at the end of 2020 and the early part of 2021. That was the last time you saw a really deep discount in relative price to earnings multiples for these defensive sectors. And we're starting to drift to that level again here.
And why do you, I guess from a macro perspective, if we look at just specifically maybe the US economy, it seems like potentially the Fed is starting to loosen, or they're not going to loosen, but then maybe they're going to start not hiking, potentially even think about pivoting. Economic data is quite strong. Inflation is going down. Is there any, I guess, economic data that you're looking at that you think says that things could go bad or things could go good, or is it more just you're watching those valuations and comparisons?
There's economic data to support this as well. we think that what maybe gets missed just because the last couple of bear markets that we had happened so quickly that everyone's gotten used to, if it doesn't happen within 2 or 3 months, things are just going to snap back and it's really not that bad. But when you have a regular economic cycle where the Federal Reserve and other central banks are going through this period of hiking rates, it tends to take over a year for that to work its way through the economy. And an example of that would be, for instance, a lot of people, if they're buying a new car or leasing a car, it's a loan of probably about 4 to 5 years in duration. So if someone who was able to get a car loan for under 4% rate several years ago, now if they were going to go back and they needed to take out a loan for a new car for the first time in 5 years, they're going to be paying nearly an 8% rate on that loan. That's a significant hit to their disposable income, but you're only doing that every several years. And so it takes a little while for the increase in rates to work its way through and affect businesses trying to take out loans or consumers that are trying to take out loans for cars or new homes, which everyone locked in such a low mortgage rate. That hasn't been quite as relevant for people because they've just been staying in place. Or you're seeing a very high credit card rate, which is now nearly 21% here in the US. And as people maybe have to pay down or lose the remaining of their excess savings and might have to take on more credit card debt, that rate would be an issue. But because I think people locked in such a low rate on their current homes that they own, and they had a lot of excess savings from the first couple of years of the pandemic, it's just taken a long time for this to play out. But we still have a gap between the leading economic indicators, things like the new orders number and the monthly manufacturing purchasing managers index, which came out today and was a negative number for the 11th straight month. Those sorts of leading indicators historically show that economic weakness is ahead. And there's a big gap right now between those leading indicators being negative versus the coincident or real-time indicators still showing some slight growth. But you can go back to every recession to the 1960s, and that gap has been the same. And eventually the real-time data catches up, and you start to see negative growth in the actual economy somewhere in the next 12 months.
Okay, interesting. But that doesn't have to be a, a collapse, I guess, like a lot of people are thinking. It could just be the economy slows down, Fed loosens, and then maybe go back to where we were 2018, 2019, where it's just a bit more steady. Is that what would that be a base case, or what, in your opinion, what's the base case?
It's hard to tell. So just because we have this really large inversion between like high short-term treasury rates and lower long-term treasury rates, that doesn't mean that we're going to have a worse recession than normal or a more shallow recession. So it's difficult to predict the depth. I think from our standpoint, in terms of how we're trying to manage money, we're just looking at the starting valuations, what we're seeing currently in the marketplace, and where we still see some assets that we think are pretty speculative get bid up to levels that we think are just mispriced. And we think that they haven't priced in an economic reality where we have very little real growth in the economy, and nominal growth in the economy kind of comes back down to a pretty low level. And that still has to be priced in. And that could easily be a 15 or 20% drop in the overall equity market. And that would just get you back to more closer to a fair value. That's not even something that would put you at a very undervalued level for stocks. And in the meantime, the nice part is you do have these higher yields, so you don't have to take the same risks that we did from 2010 all the way up to 2020 when rates were zero. And you really had no alternative but to try and pick your best assets on the riskier side of the spectrum.
Yeah, it definitely it makes sense. It's really interesting to think about that. So if we you mentioned there's some sort of industries that you're looking at, so and some sectors, I guess. From there, is there any specific industries? I guess would that be sort of supermarkets, or you mentioned utilities as well. Is there anywhere else specifically that you think is maybe as a sector is undervalued, or is it more just picking those companies?
There are certain areas within each of those sectors if we're just focused on the defensives for now. So within healthcare, we've put some money into the health insurance businesses that had traded off over the last several months. We're finding a few of the pharmaceutical companies that have gotten to very high free cash flow yields or very low price to earnings ratios, depending on what you want to look at. It seems as if within the pharmaceutical space, there's been a few really large winners, usually related to some of those new drugs related to weight loss or Alzheimer's. Those stocks, like an Eli Lilly or a Novo Nordisk, have really shot higher, but it's left some of the other pharmaceutical stocks at very reasonable valuations that you can get a decent dividend, a lot of free cash flow coming off of those companies, and it gives you a safe place to be for a little while. So within healthcare, that's where we've gravitated at the moment. In utilities, you really just want to make sure that you're buying a good regulated utility. If you're looking in the United States, that's not going to have anything that's going to really surprise you in terms of its activity or any government regulation that might hinder their business and their returns. In consumer staples, there's a few that are on our radar. We're very selective in terms of the valuation we want to pay. But at any point in the weeks or months to come, we could end up adding a few of those. And there could be some in the packaged food area, the household and personal care, beverages, or supermarkets are all areas where you're seeing one or two names that are starting to get closer to the valuations we want. We're just willing to wait until we get the price that we really would like to have before we move.
Sure, that's not a hard thing to wait and wait for that specific price. Does that price, like, I guess it adapts with earnings, and does it adapt with other factors as well? Or is it mainly just down to, I guess, the earnings and the forecast of future earnings?
Yeah, well, it depends on the company. Usually we have an absolute target price level that we're searching for, and it will adjust based off of our earnings forecast and what we expect, or just what our fair value estimate of what the company is worth. So if a company is growing at a certain rate per year, you will see that entry point move up a little bit over time that we'd be willing to pay. But we've just, having gone through multiple economic cycles, know that trying to make sure that our opening buy is at a significant discount to what we think the stock is worth tends to limit your odds of a really bad outcome. And for us, we always want to try and buy things where we think our downside is less than 20%. And there might be a little bit of a weakness in the interim after we buy something, if it's got a little bit further down to go. But if we think we're buying at what is a very good price, it's usually not more than about 10%. And then the stock and the company will start performing in our favor. An example of that we bought several months ago was Kinder Morgan, which was one of the well-run pipeline businesses. They had reached a 7% dividend yield, which is rare for that company. And even though all of its fundamental business metrics were stable, I think it was just the rates having moved up across the spectrum. We're also pushing up the dividend yields of some of these companies that aren't growing that fast, but still have good overall companies. And so we were able to buy in there at a 7% yield that just kind of locks in a good rate of return in terms of that dividend that our clients will receive, but then also gives us a chance for the valuation to expand in the months or years to come.
Yeah, it's a great insight to look at. And then how long are you holding these companies for? I guess on average, I'm sure it depends if it hits that fair value price, but I guess say if it's a bit of a slower burner, how long would you plan on holding these investments?
For our stock portfolio, we always take a 5-year outlook, and that's the goal is to, on average, hold a position for about a half decade. If some of these positions run far through our fair value estimate, so let's say we bought something at a 20 or 30% discount to what we think it's worth, and then it goes up by 70 or 80%, and all of a sudden it's trading far above what we think it's worth, then it's time for us to consider whether to take some profits off the table. Are the earnings going to catch up to that valuation? Sometimes that's the case. But we really start monitoring things closely at that point, because if it's trading well above what we think the business is worth and you start seeing some stock price weakness, then it might be a good time for us to take profits. One thing we're very mindful of, though, is even if we sell short of that 5-year time horizon, we always, as much as possible, want to sell at a long-term capital gain rather than a short-term, just because there's such a difference there in terms of the net return that you receive. In terms of the companies that are slower growth, those are the ones that I think our time horizon's a little bit shorter, maybe more like 1 to 3 years in some cases, if it's not really a core asset we want in our high income portfolio. Because with some of those, they really may not grow all that fast while they pay anywhere from a 5 to an 8% dividend. And if you can buy 20% below fair value and then sell after it goes up by 30% in 15 months, that's a heck of a good return for something that you were probably only expecting to get about 10 to 12% annualized as it was.
Yeah, it's a great point. I guess if we look at other assets, I know, we've mainly been talking about equities and sort of companies. Are there any other assets, I guess, that you would that you're looking at? You think maybe undervalued, so it's like commodities, bonds, anything else?
Yeah, for bonds, we really just focus on treasuries. And then for our conservative fixed income strategy, we'll look for long-term municipal bonds in certain areas of the country that we think are good fits for our clients' portfolios. But we're really trying to minimize credit risk as much as possible in terms of the bond portion of the portfolio. Another area that we like is the preferred stocks of the too big to fail banks. So JP Morgan Chase, Citigroup, Bank of America, and Wells Fargo. Those four companies are the relative winners within the US bank industry. And we think they're going to be around for a long time and will be able to continue paying the coupons on their preferred stocks. So those are areas that you can get anywhere from a 6 to a 10% coupon yield right now for the issues that we own for our clients. And it doesn't quite have the same upside in terms of the price of those assets, but it's a good, consistent yield that we expect to continue to earn in our clients' portfolios. One other area that we also will have a bit of exposure to is gold, and then the highest quality gold royalty and gold miner stocks is just another way to own something that we think will appreciate in US dollar terms over time, but really not have much correlation to the rest of the portfolio.
Yeah, is that how you plan to, I guess, allocate the portfolio, try to obviously reduce or, reduce the risk and try and make sure there's going to be correlation, but try and mitigate that as much as possible.
Yeah, we think it's a good place to be. Just over time, it tends to hold its value in US dollar terms, if not appreciate a bit. And there are a few different gold-related companies that tend to outperform even the price of gold over longer periods of time, especially those gold royalty stocks that are just a fantastic business model, but you have to wait for the right valuation to jump in, and then it can actually do quite well for you.
Yeah, makes sense. So, Chance, thanks so much for your time today. I really appreciate it. My last question is, what is one message you'd like people to take away from our conversation?
The thing I think we've really been communicating to clients is just the return of cycles that we have in the economy. The 2010s was the lowest volatility decade that I think anyone has really followed in terms of trying to measure going back the last 100 years. And that was not a normal environment where you could just own an index fund and expect 12 to 15% return every year over time. We think we're going back to a time where there's just more volatility in inflation and asset prices, and it pays to stay balanced in your portfolios and have an ability to stay flexible and adapt, because there'll be times where there are a lot of opportunities and times when there's very few opportunities. And for us, we're just trying to be very mindful of that and make sure that our clients' portfolios are situated in the right places so that we can minimize the downside and then really be able to take advantage when we get a great pitch and can take a swing at it.
Yeah, it's a great point to take away. So thanks so much for your time today. I really appreciate it. So if anyone wanted to find out more about your work or Oxbow as well, where would the best places for that be?
Yeah, the two great places to look are our website, oxbowadvisors.com, as well as our YouTube channel if you look for Oxbow Advisors.
Perfect. I'll put that in the description below, but thanks again for your time.
Thanks, Anthony. We like to provide the information we think is most valuable for investors. If you'd like to see more videos like this, please subscribe to our YouTube channel.